Hello and welcome. Today's discussion will walk through what bonds really are, how they impact Forex movements, and how traders can integrate bond market data into a broader trading strategy. Whether someone's a beginner exploring the Forex world or an experienced trader sharpening their edge, one thing remains true: understanding bonds is essential. Bonds are not just for portfolio managers or conservative investors. They are a fundamental piece of the puzzle in Forex trading. Typically, when bond markets speak, currency markets often listen. A bond is essentially a loan from an investor to a borrower, typically governments or corporations. In exchange, the borrower agrees to pay back the loan over time, along with periodic interest payments called coupons. The value of a bond can rise or fall depending on market interest rates, creditworthiness, and economic expectations. But here's the crucial link for Forex traders. Government bond yields, especially for major economies like the United States, Eurozone, and the United Kingdom, have a direct and often powerful influence on their respective currencies. To understand the connection between bond yields and currency movements, traders must first grasp the concept of yield. Yield is the return investors get from holding a bond. When investors demand more yield, it usually signals expectations of higher inflation or stronger economic growth. Central banks, in response, might raise interest rates to manage inflation. Rising interest rates tend to attract foreign capital because they offer higher returns on investments denominated in that currency. The result? The currency strengthens. Take the US dollar, for example. When US Treasury yields rise, it often reflects confidence in the American economy or expectations that the Federal Reserve will raise interest rates. Investors from around the globe move capital into US assets to capture better returns, increasing demand for the dollar. The opposite is also true. When yields fall, especially unexpectedly, the dollar can weaken as investors look elsewhere for better returns. This is where things become truly interesting for Forex traders. By monitoring the direction of bond yields, particularly the 10-year government bond yields of the US, Germany, and the UK, traders can anticipate possible currency movements. But it's not just about watching the absolute yield. It's also about tracking the spread between yields of two countries. For example, if the yield on US 10-year treasuries increases while German bond yields stay flat, that widening interest rate differential tends to favor the dollar over the euro. Traders call this yield spread analysis, and it's a powerful tool for identifying long-term currency trends. In fact, many institutional traders use the interest rate differential as a core strategy. They enter long positions in currencies with higher yields and short those with lower yields, a practice known as the carry trade. While retail Forex traders may not have the same capital or leverage, they can still use this insight to align trades with the broader macro trends being shaped by the bond market. Another layer of complexity arises when central banks intervene. Traders must pay close attention to central bank communications. When the Federal Reserve, the European Central Bank, or the Bank of England provides forward guidance about future interest rate policy, bond yields often move in anticipation. This is where Forex and bond markets become a feedback loop. For instance, if the Fed hints at a rate hike due to inflation pressures, bond yields will likely rise ahead of the actual decision. Forex markets, sensing the shift, begin pricing in a stronger dollar before the rate hike even materializes. This is why traders must learn to interpret economic data, not just on the surface, but in terms of how it might influence bond yields. Take inflation reports, employment figures, and GDP growth. All of these can cause sharp movements in bond markets, which then ripple into Forex markets. For instance, a stronger than expected US jobs report might raise expectations of Fed tightening, pushing up treasury yields and strengthening the dollar. But relying solely on bond yields is not enough. Bond markets offer a strong macro signal, but they should be balanced with other forms of analysis, such as technical analysis. For short-term trades, bond data might provide context, but price action remains king. A trader could be right about the fundamentals, but mistime the entry and exit without technical confirmation. It's also critical to remember that sometimes bond markets can send mixed signals. For example, if yields rise due to inflation but economic growth is slowing, Forex markets might hesitate. In this case, traders must interpret the why behind yield movements. Are yields rising because of robust economic activity, or because inflation is eroding purchasing power? That distinction matters. The geopolitical landscape also plays a role. During times of global uncertainty, investors often flock to safe haven assets like U.S. Treasuries. This demand drives yields down but strengthens the dollar due to capital inflows. So, in such scenarios, falling yields can paradoxically accompany a rising dollar. Forex traders must be alert to this inverse relationship, especially when risk sentiment dominates the market narrative. Let's not forget emerging market currencies. These are often extremely sensitive to bond yield movements in developed countries. When U.S. yields rise sharply, money often flows out of emerging markets, weakening their currencies. This creates ripple effects in global Forex markets and increases volatility. It's also worthwhile for traders to keep tabs on the bond futures market and inflation-protected securities like Treasury inflation-protected securities. These instruments give deeper insights into market expectations about future interest rates and inflation. If tips show rising real yields, it's a signal that inflation-adjusted returns are improving, which can further boost demand for the dollar. So how should traders use bond data in real time? First, by regularly tracking government bond yields on platforms like TradingView, Bloomberg, or financial news outlets. Second, by watching how those yields respond to key economic data releases. Third, by monitoring central bank commentary and rate projections. When these three pieces align, rising yields, hawkish central banks, and solid economic data, traders can build high-probability setups favoring the yield-dominant currency. At the same time, traders must factor in other influences: political stability, trade relations, commodity prices, and broader risk sentiment. For instance, if crude oil prices spike and Canada's bond yields rise in response, the Canadian dollar might gain strength. However, if global equity markets crash at the same time, traders might flock to the US dollar as a safe haven, muting the loonies rally. The point is, no market moves in isolation. Bonds, currencies, equities, and commodities are all part of a larger ecosystem. Successful traders think in terms of intermarket relationships. They study how bonds influence Forex, but also how equities reflect risk appetite, how commodities shape inflation expectations, and how geopolitics can override everything in the short term. To put this into practice, a disciplined Forex trader might start the day by reviewing overnight bond yield movements. Was there a sudden spike in U.S. 10-year yields? Did the Bank of England issue a dovish statement, causing UK yields to drop? Combine these clues with economic calendars and technical charts. Look for confirmation. If euro to US dollar is approaching resistance at the same time German bond yields are falling and US yields are rising, a short position might make sense, supported by both fundamentals and technicals. In conclusion, the bond market isn't just background noise for Forex traders. It's one of the most informative and predictive signals out there. Yield differentials help shape currency flows, central bank expectations, and investor sentiment. But like any tool, bond data must be used wisely. It works best when paired with technical analysis, macro awareness, and a disciplined trading mindset. So, whether a trader is scalping intraday or positioning for a longer swing trade, keeping one eye on the bond market can make the difference between a decent trade and a highly informed one. As with any skill in trading, mastery comes with practice. By regularly analyzing bond yields and integrating them into Forex strategies, traders can gain a clearer view of the market's heartbeat and stay one step ahead. Well, that's it for now. We will meet in another trading topic. Thank you.